Good morning and welcome everyone to the Moneycontrol live stream. You're watching the opening bell and I'm your host Nickey Mirchandani. Well, Indian equity markets likely to continue its dream run. Technical indicators right now are suggesting a bit of overstretched levels for markets. SGX Nifty now becomes Gift Nifty and that suggests a positive start to trade versus Nifty futures close on Friday. The tech-heavy Nasdaq registered the first half performance, the strongest first half performance in almost 40 years on a Friday. Let's talk about Asian stocks. Trade higher on Monday following a rally in the US market last week amid signs of cooling US inflation. Let's talk about the FIIs. Well, they continue to lend in support with bought shares worth around 6,397 odd crore. That's a big number. DII too have been on the buying side to an extent of around 1,197 odd crore. Well, a bit of FNOQs out there. 108 stocks have seen long build-ups, and they include the likes of Escorts, Birlasoft, Bandhan Bank, HDFC, AMC and Biocon amidst others. And also, if you talk about long unwinding, almost 14 of them there. Canfin Homes, Piramal Enterprises, Bajaj Auto, JK Cement and Polycab India are the ones amongst the one which have seen long unwinding. Let's talk about 31 stocks which have seen short covering, and this list includes the like of Aditya Birla Capital, Emphasis and Max Financial Services, Coforge and Cummins India. Well, let us get going and discuss some stocks and strategies now with Prashant Shah, the founder of Catalyst Wealth out there. Good morning there, Prashant. It's been a while that we've spoken to you. How do you view the markets, the levels to Nifty and strategies? There is a surge in the Nifty followed a breakout from the period of consolidation, right? Which indicates a strong bullish reversal. Do you agree with that? And if yes, what's the level and the strategies that you'll now suggest to our viewers out there?
Hi Nickey, good morning and good morning to all the viewers. Yeah, it has been a while since we connected last time. So I think the word that you used right at the start, dream run, I think that exactly is the word which very much summarizes the kind of rally we have seen in Nifty. And I think currently, if you see, we closed July futures somewhere around, we'll say 19,250. So according to me, 19,400, 450 is the level that I'm tracking. But overall, if we get a dip now, say anywhere between 19,250, 300, I think that would be the strongest dip possible. Why? Because it would be a dip above the previous all-time high, which in technical parameters happens to be one of the strongest patterns to buy any stock or any index. So I think I would not chase the index today, but I would wait for a dip somewhere around 19,200 levels in July futures. If I get that, my stop loss would be 19,000 and I would hold for targets around 19,600, 650. But as against that, if I look at Bank Nifty, I think the scope here is greater now at the current levels. We closed somewhere around 44,800, 850 on Friday in July futures. And I think 45,000, the main emotional number, happens to be a small hurdle. If we take that off, even on a one-day closing basis, I think we can very easily see around 500-600 points more. Overall, my view is that Bank Nifty in this rally, even if a dip comes, may go as high as 45,800, 46,000. So from the current levels, if I were to choose between indices to enter fresh, my choice would be Bank Nifty. And for Nifty, those who are holding longs, I would say you trail with a 100-point stop loss. That means if you see Nifty futures trading at 19,400, your stop loss in the system has to be 19,300. So that in case of any reversal, your profit is booked out at a very nice level.
All right, so that's pretty much covered the basis for Bank Nifty and Nifty. Buy on dips, probably fresh buying can be initiated on Bank Nifty level, support-based buying. And if you're long on Nifty, then probably 100 point is your stop loss trigger. That's the view coming in from Prashant. But two profitable bets out there before we address the stocks and news, Prashant.
So I have three of them, Nickey, and the first one would be from IT. I'm tracking TCS, and I think Infi and TCS both look to surprise the market in the month of July. So for TCS, my stop loss would be in spot 3,275, and I'm looking at targets around 3,360, 375. So overall, I'm looking at a strong move coming from the front runner of IT, TCS. My next pick would be in the metal sector. This has not had a great tailwind, but I think currently it is showing a lot of steam. And I would have a stop loss of 108.5 on spot closing basis. My target would be in the range of 118 to 120. And one pharma stock, it's a sector that I feel might outperform the market in the next 3-4 months. So one pharma stock would be Natco Pharma. I would have a stop loss of 670 spot closing basis. My target would be somewhere in the range of 745 to 750. So overall, I would have one metal, one IT, and a pharma pick.
All right. Also, I'm going to touch base with you on the auto stocks because monthly sales number have come in. They're a little bit of disappointment. But from the fundamental level, I think markets will just kind of, give them a benefit of doubt because monsoons thus far have been below average and they have been now progressing well. So a month of disappointing sales number might not really percolate down into the change of financials coming in or the theme coming in for the auto stocks. But your assessment, looking at the charts, anything that you like?
So I think from the current level, the one stock that is clearly making a statement is Tata Motors. I think it is trading almost the pre-open shows 600. If this happens to cross the previous levels of say 615, I think this might move strongly towards 650, 660 levels. I would suggest accumulation of this as long as the spot does not close below 580. So that happens to be your stop loss. You can hold for targets around 640, 645, even higher levels. I think this stock is ready for a big up move and a big breakout. The small hurdle on the way that happens to be 615. Once that is taken out, I think we'll see a strong move on this one.
All right, Prashant, we'll leave it at that. And thank you so much for taking out the time and joining us.
Thanks.
All right, but let's get going with the stocks that need to be on your watch list today. Of course, I'm going to be sure that you're already aware of HDFC, but what adds to your list or needs to be on your list is Vedanta, MotoCorp, Adani Transmission, and Vasa Density. I'm going to be talking about that. Aashish Kacholia's new bet out there a bit in a jiffy. Let's talk about HDFC and HDFC Bank. There's a merger which took place on July 1st. The record date is set on July 13. HDFC Bank with this is now 100% owned by public shareholders. The existing shareholders of HDFC will own around 41% of the banking stocks. Let's talk about Vedanta, where the company has announced a strategic review of the steel business. The review will begin immediately. It will evaluate options to maximize stakeholder value. This will include, but is not limited to, a potential strategic sale. The company has already engaged in advisors to assist in this review. Not much of contribution coming in from steel division per se. Even the last year, if you see the steel business, there is a bit of sentimental uptide coming in for overall the steel business. But overall, if you look at the levels, the margins that we've seen from COVID levels, they've not been that attractive. So in light of that, if the company is addressing and looking at it from a strategic sale perspective, not much of a surprise coming in there. MotoCorp. Well, auto sales have come in. Like I said, the numbers have been a bit of disappointment. But MotoCorp company has heightened prices of motorcycles and scooters by more than 1.5%. And that's effective from July 3rd. Adani Transmission, that's going to be another one, or should be another one that you need to keep on your list. GQG partners have picked up rupees 1,678 crore worth shares in the company. The promoter has offloaded around 3% stake. Now, GQG combined with Goldman Sachs, along with the partners, GQG Partners International Opportunity Fund, they have overall picked up 1.9%, that is close to 2% stake coming in the counter, and the promoter has sold in 3.04% stake. That's another one. Vasa Density, that's the one where investor Aashish Kacholia has bought in shares. It's a new buy, and almost Aashish Kacholia has bought in 4.39 lakh shares in the company. Also, what needs to be on your list is HFCL and Sterlite Tech. Anti-dumping duty is expected soon by the government on the optic fiber cables. Let's also talk about Apollo Tyres, a stock which has seen a lot of downgrades. Let's just put it, a downgrade coming in by Morgan Stanley in a market like this. Downgraded to equal weight. Target price, however, has been raised to 425. From a commodity cycle and competitive intensity is right now benign, but FY24 expect the company to post an EBITDA margin of around 15.7% and ROCE of around 11%. Overall, the risk-reward ratio seems to be balanced for Apollo Tyres, but there's a downgrade report coming in on that. So that's the word coming in overall for stocks and news. Interesting how the market has panned out and shaped up right now. It's a dream run technically and theoretically. If you talk from the paper perspective, it all looks very rosy. And that's a fair dose amount of cautiousness, or let's just say the cautiousness is playing amidst the whole investor community. The trading volumes are a little bit thin, which remains to be a cause of concern. But overall, if you see, there is a participation which has also started happening from IT counters. Banking stocks of any which way has been participative, right from the beginning, right from the word go. Now I think what can really lift the markets higher is the participation coming in from the index heavyweight Reliance Industries. If that comes in for, you can clearly see the bull run extending to the levels which are unseen thus far. Nifty 50. Let's address the market open for you. Well, we see 0.25% gains coming in for Nifty 50 and flirting around that 19,250 mark. Almost thereabouts. Let's talk about Bank Nifty Index. Well, let's see, there is an outperformance coming in from Bank Nifty Index. We are looking at gains to an extent of 0.4% coming in on Bank Nifty as well. Let's also talk about the mid cap index and the small cap index just to see if the outperformance trend overall continues for that one. We are seeing gains to an extent of 0.5% coming in from mid cap, and from small cap we're looking at gains to an extent of almost more than 0.5%. So clearly small cap index at this point of time is outperforming the larger counterparts. Talk about the sectoral indices. IT, like I said and pointed, Nasdaq witnessed a sharp rally on account of tech stocks, and in our market it's no different. Probably the trend is just picking up. FMCG, well, monsoons have been faring well thus far, and you can probably give the credit to the monsoons. If that continues to be above average, you can see more rally coming in on the FMCG and the auto basket also. Auto stocks are the one which apparently for the month of June have posted some amount of disappointment coming in from the sales number. But like I said, market participants will probably given benefit of doubt coming in for Nifty 50, auto index. Let's also talk about HDFC and HDFC Bank. That's where the merger has happened. But before that, let's address in top gainers and top losers that we have on our screen right now. Well, HDFC Bank too has been doing well with gains of around more than 1%. So that's clearly some amount of traction building in, right? 1.5% gain. So clearly it's been lifted by the financials. Let's also talk about the top gainers and the top losers that we have on the screen right now. M&M, Ultratech Cement and JSW Steel. Well, industrials have actually made it on the top gaining list, and HDFC, Eicher Motors and DV's Lab. These are some of the other top gainers that we have overall on the top in the list right now. Wipro, HDFC Bank and Adani Ports. So technically much of the sentiment, again, it's the twins which are doing the trick for the markets. And probably look at the losers out there. Maruti Suzuki, Power Grid and Bajaj Auto. These are some of the losers that we have on the list right now. But we're going to quickly navigate our discussion now to the fundamentals, because there's a lot to talk about, right? A dream run coming in for the markets. And to take us forward to the discussion is Aashish, Somaiyaa, CEO and Executive Director at WhiteOak Capital Asset Management. Good morning there.
Hi, good morning.
Okay, I know we have limited time coming in for us, but I'm just going to start off by asking you about the markets. There's a dream run which has come through, record high levels, pretty much what the investors were looking for. But if someone has missed the rally thus far, what is a wise strategy to construct their portfolio? How can they look at the newer areas of diversification, Aashish?
Yes, actually we are noticing a couple of things which might be surprising. On the one hand, if I were to look at, industry flows, I'm quoting these numbers more from perspective of understanding the kind of behavior that is playing out from investors at this point in time. My scope of work, so I'm talking mainly related to mutual funds, PMS, those kinds of managed equity products. So the one trend that we are seeing, if you see May data, and potentially you will see it when the June mutual fund industry data comes out, you will find that the net inflow is muted, which means that despite the huge amount of inflow which comes in the industry, there is equal money which is going out also, which means that higher and higher level people seem to be pulling some money off the table. The second thing is, so the net flow is muted, and the second thing which is a bit surprising is that bulk of the net positive flow is hovering around small cap funds and mid cap funds. So very, very divergent behavior coming in from investors. On the one hand, some people at new highs are taking money off the table. On the other hand, at new highs, some people are getting pulled into small and mid caps because they are showing amazing performance, because of the new high and, the more broad-based conduct of the market. Now, that's where the hint lies. I think that if anybody is entering the market now, they need to be a bit careful. And, generally we tell people they should park money in a liquid fund and make sure that their entry is spread at least over the next 6 months. Also, I'm saying this not just based on the industry data or investor behavior, but also you should keep in mind that from March till now, in a span of about 3 months, we are nearly 20% higher. While I don't see any reason, I don't mean to say it's not backed by fundamentals. I can see the FPI flow, I can see the positivity for India, and I can see the fundamentals as well. But the point is, whenever the market rises up so sharp and so fast, definitely people need to be a bit careful.
All right, so a bit of caution coming in from there. But however, if you look at the institutional behavior, FIIs, like you just pointed out, they've been buyers thus far, and that's a trend which otherwise is not being played out for the last couple of years. With respect to that, do you think domestic institutional fund houses like yours probably are now looking at markets differently and probably looking at market like this like an exit opportunity? And if that's the instance, if not for any other asset, just looking at the equity asset class, any themes right now which look like an attractive bet?
So two things. One is, at the end of the day, because we are managing public money, if investors subscribe to funds, then we are buyers. And if there are more number of people taking money off the table than there are people putting money on the table, then obviously we will be sellers. So that is one. And there, whatever is the industry, I mean, my fund house or my company is, we've been in mutual funds only for the last 7 to 8 months. So we are not really the bellwether, or we are not really an indicator of what is happening. But broadly speaking, I've told you what is happening. So you can imagine that, mutual funds are not seeing a very, very high amount of net flow. And like I said, whatever net flow is there is hovering or, focused around small and mid cap. That is one thing to keep in mind. Second is, that doesn't mean that I am actually bearish or something. The point I was just trying to make is that whenever you see money focused totally on small and mid cap or sectoral or thematic funds, and whenever you see market really shooting up too fast, in a very short span of time, that is where you should be a bit cautioned, and that is more for the next 3 to 6 months. I think that if anybody has even 18 to 24 months, or if anybody's going to look through at least for the next year and a half to 2 years, I think still there is significant potential and significant upside as far as our markets are concerned. And as far as FPI flow is concerned, it's a function of many, many things. The whole of last year, US rates were rising, the dollar was exhibiting tremendous strength. And those are the times when emerging markets don't tend to get too much flow. Second is, emerging market basket itself was in trouble last year because of China, Russia, Taiwan, and what have you. But after March, obviously the strength of the dollar has given up a little bit. There has been a sort of expectation that there'll be eventually a pivot in US policy rates, and that has resulted in flow into emerging markets. And within emerging markets, clearly India is a preferred destination because it stood out in the last 3 to 4 years. So I do find that there is sustainability in whatever is happening, but the word of caution is more related to the here and now, maybe for the next 3 to 6 months, because any kind of event or any kind of negative surprise could definitely give a setback.
So thus far, Aashish, it's the rate sensitive, essentially the banking sector, which has been the front runner for the rally. Of course, FIIs have poured in money, and by virtue of that, you're seeing financials doing extremely well. But do you think a setback by this means that a hit coming in, the first downfall will probably be witnessed into pockets like banking sector and then probably auto sector? How do you view that? I mean, which is going to be the first sector which probably take a sharper hit if things were not supposed to go in the north direction from here on?
That's very, very hard to figure out. Either which way, we will never be a sectoral investor. So we run portfolios which are typically benchmarked to BSE 500, and hence we have very broad portfolios investing across sectors and across market caps. So very, very hard to figure that if at all there were to be a negative surprise. Like, say, what could be the negative surprise? Say, for example, as far as US is concerned, a lot of the action of their monetary policy we've seen through last year, but still, we still have something to watch out for. Because, when the economy is, whether it's a hard landing, whether it's a soft landing, when economic data is changing, obviously it doesn't change unidirectionally. You'll get a couple of data observations which suggest something, and then there'll be a couple of data observations which suggest something else to the contrary. So from that perspective, even if there is a hard or a soft landing, you cannot expect data to go unidirectionally. From time to time, there will be surprises on the monetary policy or the American, Fed pronouncements. That could be one. Second is we ourselves are obviously headed into a massive event, which is the general election. And in the run-up to the election, state elections and all kinds of news and headlines coming in, and that also does tend to, if not cause volatility, at least for some people on the margin, it can make them postpone some investment decisions. So there are reasons why we could see volatility around the corner. Very difficult to figure that if there was volatility, what segment or what pocket of the market it would impact. It stands to reason that something which has really run up too fast, too soon, always hints at the risk element being there. So from that perspective, getting overexposed to any thematic or sectoral funds, getting overexposed purely just to small and mid caps, I think these are the things that one needs to really caution about.
All right, so that's the word, a bit of cautiousness clearly, which is sensed from Aashish's conversation. But from a very broad perspective, if any themes that you were if you were supposed to choose, I get your point when you say that you've spoken that equity markets and sectoral, you don't want to focus much on these. But if you were a market participant who just gung-ho on equities and any sector theme, if they were supposed to pick, then what's going to be the best bet out there?
Yeah, so, like I said, if we were to look through some of the events which I pointed out and, look at, say, 18 to 24 months, then very much gung-ho, no reason to be negative on markets. As far as your question is concerned, I would still say that, like you mentioned at the early on of your comments which I was listening, say private sector financials definitely have potential. Apart from that, maybe pharma. We do have a bit of a contrarian bet as far as our portfolios are concerned because we have mid-cap IT, slight overweight on IT, as well as significant preponderance of some mid-cap IT stocks in our portfolios. So that is something that we're positive about. Industrials, definitely we are overweight. And apart from that, I would say even the non-lending financials, everything to do with capital markets, which includes asset managers, wealth managers, the exchanges, RTAs, depository participants, insurance companies, the entire pack of non-lending financials. And lastly, consumer discretionary. So these are the areas where we are overweight, and maybe that's what the team seems to be finding a large number of ideas from.
Sure. Aashish, if you remember, we spoke at the start of the year, and now it's almost a mid-year assessment out here. Anything that has changed, given the view that you have? Sure, it's going to be a long-term view that you just discussed, but given how the markets have behaved, given how, FIIs have come strongly into equity markets, anything of that changes for you?
Yeah, I do recall maybe we spoke around, maybe 1st, 2nd or 3rd January. And at that point in time, I used to think that, the early part of 2023, would have been negative or challenging. And the latter half is when one would have expected significant upside. It's never possible to get the timelines correct, but rightly or wrongly, we did see that right from January to March, we hit like an air pocket. And from April, May onwards, we are now, by the time we hit July, we are seeing market making all-time highs. I don't give huge credit to my ability to call the market, and I don't have similarly any, great belief about anybody else calling the market correctly. But having said so, I feel that from here on till the general election, my sense is that, and plus, I also alluded to what is happening in the US. We've not seen the back of that whole macroeconomic problem and the monetary policy actions. So I would say that next few months, I will be surprised if we keep going one way up. Like I said, next few months we are likely to witness some amount of volatility because of whatever events. And if somebody is looking for significant upside, or if somebody is looking for market convincingly making new highs, then I would say at least 18 to 24 months out from here is what I would watch for.
So according to you, it is not a structural bull run that we're witnessing, and there is a scope of further correction. And if that's the case,
Structural bull run, yes, but in any bull run there will be corrections from time to time.
so okay, if you were just supposed to look from a very short-term perspective, a strategy that you don't really adopt to, if you were just by the end of the year supposed to put hypothetically any targets that you'd probably see Nifty at, and any risk to those targets, what would that be?
I would be wary of putting a target because, like I said, sometimes we make certain pronouncements based on our best guess and then it plays out, but I don't think we should take credit for it. And at the same time, I don't think we should really put too much emphasis on making targets. But with due respect to your question, I would put it this way. If you put a gun to my head for, say, end of this year, very difficult to put a target, but I don't think we are going much further than plus minus 10% from where we are. I am conscious that 10% from here is a very, very big number. I would say that probability of 10% higher from here, that probability is lower than probability of say 5-7% lower from here. So maybe long answer, but I think we are not going too far from where we are. Maybe we'll be range bound if you were to ask me by the end of this year. And like I've said a couple of times before, if you allow the liberty of say a couple of years out from here, then maybe significantly higher.
All right, Aashish, that's quite a perspective for us this morning, and thank you so much for taking out the time and speaking to us.
Thank you. Thanks for inviting me.
Pleasure. Well, with this, it's a wrap, and goodbye from the entire team who puts this piece together. Thank you so much for watching, and please do post your feedback for us in the comment section below. Follow us on the link at the bottom of your screen, and for rest of the updates, stay tuned into moneycontrol.com and Moneycontrol app.